Are you an Australian over 55, asset rich but cash poor? Do you own your home but worry about having enough money for retirement? You might have heard of a reverse mortgage, but how do they actually work? And more importantly, how much will it cost you in the long run? Today, we're breaking down a real-life reverse mortgage calculation. We'll look at a $100,000 home, see how much cash you can get, and most importantly, see what happens to your debt after 15 years. Let's dive in. First, let's cover the basics. A reverse mortgage is a special loan for homeowners aged 55 and over. It lets you tap into the equity you've built up in your home without having to sell it or move out. The key feature? No regular repayments. You don't have to pay back a cent until you sell the home, move into aged care, or pass away. You can take the money as a lump sum for a big expense, a regular income stream to top up your pension, or a line of credit to use when you need it. And importantly, you remain the legal owner. You just have to keep paying your rates and insurance. Okay, let's look at the numbers. I'm going to use a real calculation example. Let's say you're 70 years old and your home is worth $800,000. In Australia, how much you can borrow depends on your age. At 70, a typical lender might offer a loan-to-value ratio, or LVR, of about 25%. So in step 1, your available lump sum is $800,000 times 0.25 equals $200,000. Simple enough. You get $200,000 tax-free cash. Now, step 2 is where it gets tricky. Because you're not making repayments, the interest gets added to your balance. Let's assume an interest rate of 8.5% per annum. We're going to look at this over a 15-year term. The formula for compound interest is brutal. If we calculate the future loan balance, that initial $200,000 debt after 15 years at 8.5% interest blows out to approximately $679,000. That's a big number. But remember, your house hasn't been sitting still. Step 3, we need to estimate the future home value. Let's assume a modest property growth rate of 3% per year, which is pretty standard. If we calculate that, your $800,000 home today could be worth roughly $1.246 million in 15 years. Now for step 4, the moment of truth. What's left for you or your estate? We call this net equity. Future home value, $1.246 million, minus future loan balance, $679,000, equals $567,000. So in this scenario, even after the loan and all that compounded interest, you or your heirs still walk away with over $500,000. You spent $200,000, but your equity only dropped from $800,000 to $567,000. But what if the market doesn't perform? This is step 5, and it's crucial. What if your home only grows at 1% per year instead of 3%? Maybe the market stagnates. After 15 years at 1% growth, your home is only worth about $928,775. We still owe the same $679,000 on the loan, so the net equity left is $928,775 minus $679,949 equals $248,827. Your equity is significantly less. In extreme cases, if the market went down, the debt could eat up almost all the value. But here is the most important part for Australian viewers. We have something called the no negative equity guarantee. Even if your loan balance tries to grow bigger than your house value, which it mathematically could if interest rates stay high and growth stays low, you will never owe more than the house's selling price. The lender has to wear that loss, not you or your estate. You cannot be left with a debt you can't pay. You will always have somewhere to live. So, to summarize, you can unlock cash from your home without selling, interest compounds quickly so the debt grows fast, your home's growth rate is the biggest factor in how much equity is left, and thanks to Australian law, you're protected by the no negative equity guarantee. If you're considering this, always speak to a qualified financial advisor who specializes in retirement income. It's a big decision, but for many, it's the key to a comfortable retirement. Like and subscribe for more Australian property and finance explainers. See you in the next video.